Ionic Digital Inc. Pre-listing Institutional Research Report. From Celsius bankruptcy wreckage to a $2 billion AI infrastructure landlord. Section 1. Executive Summary. Ionic Digital Inc. is a Washington, D.C.-based digital infrastructure company with an unusual origin story. It was formed in January 2024 specifically to acquire the Bitcoin mining assets of Celsius Mining, the mining subsidiary of crypto lender Celsius Network, out of that company's high-profile 2022 bankruptcy. As of this report's date, Ionic is not yet publicly traded. The company expects to begin trading on the Nasdaq Global Select Market under the ticker IOND on July 28, 2026, via a direct listing rather than a traditional underwritten IPO. In plain terms, this is not a normal IPO. In a direct listing, the company does not sell new shares or raise any new money from the public offering itself. It simply allows existing shareholders to begin freely trading their existing shares on a public exchange. Ionic will receive zero proceeds from the listing itself. All the capital it needed was already raised via a $400 million private placement completed on June 26, 2026, at a $53 per share price, implying an approximate $2.0 billion valuation. The company's business has also transformed dramatically since its 2024 founding. What began purely as a Bitcoin mining operation has pivoted sharply toward AI and high-performance computing infrastructure. In October 2025, Ionic signed a 126-month triple net lease with global AI hyperscaler Nscale for the full 234 megawatts of capacity of its flagship Ward County, Texas data center campus, a deal the company values at approximately $1.95 billion of contracted revenue over the lease term, potentially rising to $2.6 billion with a capacity expansion option. The financial impact of this pivot is already visible. In the first quarter of 2026, digital infrastructure leasing revenue reached $44.0 million, while Bitcoin mining revenue collapsed 82% year-over-year to just $7.4 million, as the company deliberately wound down mining operations at its repurposed sites. Key facts at a glance. Origin: formed 2024 to acquire Celsius Mining's Bitcoin mining assets out of bankruptcy. Current business: AI and HPC data center leasing as primary growth driver, plus residual Bitcoin mining. Anchor tenant: Nscale, 126-month triple net lease of full 234 megawatts Ward County, Texas campus. Contracted lease revenue, approximately $1.95 billion over the initial 10-year term, up to approximately $2.6 billion with expansion. Q1 2026 revenue, $51.4 million, consisting of $44.0 million in leasing and $7.4 million in Bitcoin mining. Q1 2026 net loss, $13.0 million, narrowed from $28.0 million in Q1 2025. Balance sheet as of March 31, 2026. $34.9 million cash, $192.1 million in crypto assets, $554.0 million total assets. Section 2. Investment Thesis. The bull case for Ionic is that it has effectively converted volatile, commodity-driven Bitcoin mining infrastructure into a long-term, contracted landlord business almost overnight. The Nscale lease transforms the Ward County campus from an asset whose revenue swings with Bitcoin's price into one generating predictable, contracted rental income for a decade or more, with NVIDIA itself guaranteeing rent payments for the first 5 years, up to $860.3 million. An unusually strong credit backstop for a newly public company. Because Ionic acquired its power and land assets out of a bankruptcy estate, it likely has a lower cost basis than competitors who built or bought similar infrastructure at full market prices. And its no-debt balance sheet gives it real flexibility to fund expansion. The bear case centers on execution and structure. Ionic is asking public investors to underwrite a business that, 18 months ago, was a completely different company, a pure Bitcoin miner, now pivoting into a capital-intensive AI infrastructure business that requires substantial further investment in cooling, networking, and power capacity the company has not yet fully built out. As a direct listing, there is no traditional IPO price discovery, no underwriter-supported opening trade, and no lockup-driven gradual share release. Existing shareholders, including former Celsius creditors who may simply want to cash out, can sell immediately and in large size, which could create significant early volatility. Thesis in one sentence. Ionic Digital has real, contracted, investment-grade backstopped AI infrastructure revenue from a single anchor tenant, but it is a recently transformed, single-asset concentrated business going public via an unusual structure that offers no price support and immediate, large-scale seller liquidity on day one. Section 3. Company Overview. Legal entity, Ionic Digital Inc. Headquarters, Washington, D.C. Exchange and ticker, Nasdaq Global Select Market, IOND. Expected. Founded, January 2024. Began operations February 1, 2024. Listing type, direct listing. No new shares issued, no capital raised in the listing itself. Chief Executive Officer, Andy Stewart. Recent private round valuation, approximately $2.0 billion, based on the June 2026 Series A preferred placement at $53 per share. Financial advisors, J.P. Morgan as designated advisor, Jefferies, and BTIG. Corporate background. Celsius Network, once one of the largest crypto lending platforms, filed for Chapter 11 bankruptcy in July 2022, 1 month after freezing customer withdrawals. As part of the bankruptcy restructuring approved in November 2023, Ionic Digital was formed in January 2024 specifically to receive and operate Celsius Mining's Bitcoin mining assets on behalf of Celsius creditors, who received Ionic shares as part of their bankruptcy recovery. Ionic terminated a services agreement with an external mining outsourcer in December 2024 and took direct operational control of its sites. Corporate milestones. January 2024, Ionic Digital formed to acquire Celsius Mining's Bitcoin mining assets. February 1, 2024, company begins operations. December 2024, terminates external mining services agreement, takes direct operational control of its Texas mining sites. 2025, begins repositioning from pure Bitcoin mining toward AI and high-performance computing infrastructure leasing. October 2025, signs landmark 126-month triple net lease with N-Scale for the full 234-megawatt Ward County, Texas campus, the Cedarvale Data Center, representing approximately $1.95 billion of contracted revenue, with an option to expand to approximately $2.6 billion. June 26, 2026, completes $400 million private placement of Series A convertible preferred stock at $53 per share, implying approximately $2.0 billion valuation, led by a tester, Oaktree Capital Management, and Sachem Head Capital Management. Early July 2026, files Form S-1 with the SEC for a Nasdaq direct listing. July 28, 2026, anticipated Nasdaq Global Select Market trading debut under ticker IOND. Section 4. Business Model. Ionic now operates two distinct business lines. The first and now dominant line is digital infrastructure leasing. Ionic owns power-connected data center real estate, land, electrical infrastructure, and buildings, and leases the fully built capacity to AI and HPC tenants under long-term triple net contracts, meaning the tenant, N-Scale, is responsible for its own equipment, maintenance, and operating costs, while Ionic collects contracted rent. This is a fundamentally different, far more predictable revenue model than mining. The second, now shrinking line is direct Bitcoin mining. Ionic still owns and operates more than 110,000 Bitcoin mining machines across smaller Texas sites in Reagan and Glasscock counties not committed to the N-scale lease, generating revenue that fluctuates with Bitcoin's price, network mining difficulty, and electricity costs. Management has been explicit that it views this mining operation and the company's existing 2,815.6 BTC treasury less as a long-term strategic holding and more as a flexible capital allocation tool. Bitcoin can be sold opportunistically to help fund the capital-intensive build-out of additional AI and HPC capacity. Picture Ionic as a landlord who used to run a volatile factory, Bitcoin mining, on their property, and has now signed a decade-long lease with a stable corporate tenant, N-scale, backed by NVIDIA's rent guarantee for the same real estate, while still running a smaller, shrinking version of the old factory on the side and holding some savings in Bitcoin that they're willing to spend on renovating more of the property for future tenants. Section 5. Products and Services. Ward County and Cedarvale AI Data Center Campus. Ionic's flagship asset is a 234-megawatt powered data center campus in Ward County, Texas, fully leased to global AI hyperscaler N-scale under a 126-month triple net agreement. Under the deal, N-scale leases the entire current power capacity to support its own AI infrastructure partnerships with major technology platforms. Notably, NVIDIA has guaranteed N-scale's rent payments for the first 5 years of the lease, up to $860.3 million, with a parent company guarantee applying thereafter, providing Ionic with an unusually strong credit backstop. Microsoft separately holds an option for additional power capacity at the site if it becomes available. Management has discussed the potential to scale the Ward County campus toward roughly 700 megawatts of total capacity over time, well beyond the 234 megawatts currently committed to N-scale. Residual Bitcoin mining operations. Beyond Ward County, Ionic operates smaller Bitcoin mining sites in Reagan and Glasscock counties, Texas, running more than 110,000 active mining machines with roughly 2.0 exahash per second of contributed hash rate as of March 2026. Average power costs across the mining fleet are approximately 2.1 to 3.6 cents per kilowatt hour, a genuinely competitive cost basis within the industry. Bitcoin Treasury. As of March 31, 2026, Ionic held 2,815.6 Bitcoin in Treasury, valued at approximately $192.1 million on the balance sheet at that date. Management has explicitly signaled a willingness to sell down this treasury opportunistically to help fund AI and HPC infrastructure build-out, rather than accumulating Bitcoin indefinitely as a pure treasury strategy. Section 6. Industry Overview. Ionic sits at the intersection of two very different industries, undergoing simultaneous transformation. Publicly traded Bitcoin mining, historically a business defined by hash rate scale, electricity cost, and Bitcoin price exposure, has faced compressed profitability as network difficulty rises and hash price fluctuates. Bitcoin miners generated roughly $1.086 billion in industry-wide revenue in May 2026, the strongest month since January, before lower Bitcoin prices later reduced profitability again. In response, a clear industry-wide trend has emerged. Publicly traded miners including TeraWulf, IREN, Cipher Mining, and Hut 8 have all announced significant pivots toward leasing their power-connected infrastructure to AI and HPC tenants, following the same fundamental logic driving Ionic's own transformation. The AI data center industry, meanwhile, remains fundamentally constrained by a single resource: electrical power. Hyperscalers and AI infrastructure providers like N-scale are aggressively seeking large, already connected blocks of power capacity to avoid the multi-year interconnection queues facing new grid connections, which is precisely why previously stranded Bitcoin mining power infrastructure, including assets like Ionic's Ward County campus, originally built for a completely different purpose, has suddenly become highly sought-after real estate. Section 7. Market Opportunity. Ionic's most concrete near-term opportunity is the contracted expansion option embedded in its existing N-scale lease. Securing the necessary regulatory approvals and additional power capacity for another 89 megawatts at Ward County would lift total contracted lease revenue from approximately $1.95 billion to approximately $2.6 billion over the lease term, without requiring a new tenant relationship. Beyond that, management has discussed the potential to grow the Ward County campus toward roughly 700 megawatts of total capacity, more than triple the capacity currently committed to N-scale, which would require substantial additional capital investment but could be supported by additional tenant leases given the site's existing grid interconnection. The company's Q1 2026 results already show the shape of this opportunity. Digital infrastructure leasing revenue of $44.0 million versus just $7.4 million from Bitcoin mining in the same quarter demonstrates how quickly the AI leasing business can become Ionic's dominant revenue source once fully ramped. The single biggest number in Ionic's story isn't a market size estimate. It's the concrete, already signed $1.95 billion N-scale lease. The market opportunity here is less about total addressable market and more about how much of Ionic's remaining land and power capacity it can successfully lease to additional AI and HPC tenants at similarly favorable terms. Section 8. Competitive Landscape. Competitors include TeraWulf, listed on Nasdaq as WULF, pivoted heavily to AI, including a $9.5 billion agreement with FluidStack for 168 megawatts in Texas, and a $3.2 billion Google backstop, widely viewed as a leading Bitcoin miner to AI infrastructure comparable. Cipher Mining, listed as CIFR, Texas-based, transitioned to a hybrid compute model in early 2026, wind-powered hyperscale-grade facilities. IREN Limited, listed as IREN, dual-track Bitcoin mining and AI cloud services, posted its first net profit in FY 2025 of $86.9 million on $501 million in revenue, backed by a $9.7 billion Microsoft contract. Hut 8, listed as HUT, merged with US Bitcoin Corp, hosting and HPC revenue increasingly offsetting mining segment losses. CleanSpark, listed as CLSK, a notable exception to the AI pivot trend, largely stayed focused on maximizing Bitcoin mining efficiency. Digital Realty and Data Direct Networks, traditional data center developers now competing more directly with former Bitcoin miners for the same AI tenant demand. Where Ionic stands. Ionic's key differentiator versus most of the miner to AI pivot comparables is the strength and structure of its anchor lease. The NVIDIA rent guarantee backing the N-scale agreement is a genuinely unusual credit enhancement that most competing miner to AI conversions have not secured to the same degree. Ionic also benefits from having acquired its underlying land and power infrastructure out of a bankruptcy estate, likely at a lower cost basis than peers. Against that, Ionic is considerably smaller and more geographically concentrated, effectively a single campus story at this stage, than larger, more diversified peers like TeraWulf or IREN. Section 9. Management Team. Andy Stewart, Chief Executive Officer, brings more than 25 years of experience in digital infrastructure. Previously served as CEO of Evoke Data Center Solutions and of TierPoint, where he led portfolio optimization and large-scale financing activities. Has directed Ionic's capital-raising strategy, including the $400 million private placement completed in June 2026. Chris Hickman, Chief Financial Officer. More than 20 years of finance experience across digital infrastructure and energy sectors. previously held both CEO and CFO roles at Tillman Infrastructure, and earlier held leadership positions at Crown Castle, one of the largest publicly traded communications infrastructure companies in the U.S., experience directly relevant to Ionic's evolution into an infrastructure leasing business. Antonio Perino, Chief Strategy Officer. Approximately 30 years of experience across data centers, cloud computing, and AI. Previously served as CTO at Science Logic, and has held research leadership roles at 451 Research and advisory roles at the Uptime Institute. Governance note: as a company that emerged from a bankruptcy restructuring, Ionic's shareholder base is unusually composed of former Celsius Network creditors alongside newer institutional investors from the June 2026 private placement, Attestor, Oaktree Capital Management, and Sachem Head Capital Management. Section 10. Financial Performance. Ionic does not have a multi-year public financial history, having only been founded in January 2024. Revenue for the trailing 12 months ended March 31, 2026. $152 million. Q1 2025 revenue, 100% Bitcoin mining, $41.1 million. Q1 2026 revenue, mixed, $51.4 million, consisting of $44.0 million in leasing and $7.4 million in mining. Q1 2025 net loss, $28.0 million. Q1 2026 net loss, $13.0 million. In plain terms, total revenue grew year over year, but the composition changed entirely. A year ago, 100% of revenue came from Bitcoin mining. Today, more than 85% comes from the new AI and HPC leasing business, with mining revenue down 82%. At the same time, the company's net loss narrowed considerably, suggesting the leasing business carries a meaningfully better cost structure than mining. Capital raising history. Ionic's initial capitalization came directly from the Celsius bankruptcy restructuring, which conveyed Bitcoin mining assets. $195 million in cash, $29 million in prepaid capital investments related to the Cedar Vale site, and 540 Bitcoin to the company. More recently, Ionic completed a $400 million private placement on June 26, 2026, selling 7,547,166 shares of Series A convertible preferred stock at $53 per share, alongside 3 tranches of warrants exercisable at $63.60, $74.20, and $87.45 per share. Private placement investors agreed not to sell their converted shares below $70 per share for 6 months following the listing, subject to limited exceptions. Section 11. Detailed analysis. Latest quarterly financials. Q1 2026. Revenue. Total revenue was $51.4 million, up from $41.1 million in Q1 2025. But the mix flipped entirely. Digital infrastructure leasing revenue from the N-Scale lease was $44.0 million, while Bitcoin mining revenue fell 82% year over year to just $7.4 million, reflecting the deliberate wind-down of mining operations at sites repurposed for AI and HPC use. Gross margin and operating income. The triple net structure of the N-Scale lease, where the tenant bears operating and maintenance costs, generally implies a higher margin revenue stream for Ionic than direct Bitcoin mining, which carries significant variable costs, including electricity, equipment depreciation, and maintenance. Net income and EPS. Net loss narrowed to $13.0 million in Q1 2026, from $28.0 million in Q1 2025, a meaningful improvement, though the company remains unprofitable on a GAAP basis. Balance sheet as of March 31, 2026. Cash and cash equivalents, $34.9 million. Cryptocurrency assets, comprising 2,815.6 BTC, $192.1 million. Total assets, $554.0 million. Total liabilities, $17.2 million. Total debt, 0. No debt outstanding. Subsequent event. The Series A preferred private placement closed June 26, 2026, raising $400 million gross before approximately $16.8 million in transaction fees. Guidance. As a private company transitioning to public markets via direct listing, Ionic has not issued formal guidance. The company has disclosed planned capital expenditures of approximately $40 million through the first half of 2027 to support the current 234 megawatts plus the potential 89 megawatts N-scale expansion, and approximately $64 million for a broader build-out toward as much as 700 megawatts of total Ward County capacity, to be funded from cash on hand and, if needed, opportunistic sales of the company's Bitcoin treasury. Key changes versus previous quarter. Digital infrastructure leasing revenue became the clear majority of total revenue for the first time, at $44.0 million versus $7.4 million from Bitcoin mining. Net loss narrowed by more than half year over year. Subsequent to quarter end, the company closed its $400 million Series A preferred private placement, materially strengthening its balance sheet ahead of listing. Section 12. Growth drivers. First, N-scale lease expansion option. Securing the additional 89 megawatts of capacity contemplated under the existing N-scale agreement would lift total contracted lease revenue from approximately $1.95 billion to approximately $2.6 billion without requiring a new tenant relationship. Second, Ward County campus scale-up toward approximately 700 megawatts. Management's stated ambition to grow total site capacity well beyond the 234 megawatts currently leased to N-scale represents a substantial multi-year capacity growth opportunity, funded by disclosed CapEx plans. Third, additional AI and HPC tenant relationships. Beyond N-scale, Microsoft holds an option for additional power at the site if available, a potential second major tenant relationship that would further diversify and de-risk Ionic's revenue base. Fourth, opportunistic Bitcoin treasury monetization. Management's stated willingness to deploy the existing 2,815.6 BTC treasury flexibly provides a non-dilutive funding source for infrastructure build-out. Fifth, low-cost asset base from bankruptcy acquisition. Having acquired its core land and power infrastructure out of the Celsius bankruptcy estate, likely at a discount to replacement cost, gives Ionic a structural cost advantage versus competitors who built or bought comparable assets at full market prices. Section 13. Key risks. Risk 1. Direct listing structure and immediate seller liquidity. Unlike a traditional IPO, there is no underwriter-supported opening trade or gradual lockup-driven share release. Former Celsius creditors and other existing shareholders, including up to 10.8 million shares registered for resale, plus roughly 37.2 million additional Class A shares potentially freely sellable, can sell immediately and in significant size, creating potential for outsized early volatility with no price floor. Risk 2. Single asset, single tenant concentration. The overwhelming majority of Ionic's contracted future revenue depends on one lease with one tenant, N-scale, at one physical campus, Ward County. Any disruption to that specific relationship or facility would have an outsized impact on the company's financial profile. Risk 3. Recently and rapidly transformed business model. Ionic was a pure Bitcoin miner as recently as 2025. The company has limited operating history executing its new AI and HPC leasing strategy, and further build-out requires capital and execution the company has not yet fully demonstrated. Risk 4. Bankruptcy origin asset risk. Assets acquired out of a bankruptcy estate can carry deferred maintenance, contractual complications, or operational inefficiencies that take time and capital to resolve. a risk the company itself has been candid about in its public disclosures. Risk 5. Residual Bitcoin mining and treasury exposure. Despite the pivot, Ionic still operates meaningful Bitcoin mining infrastructure and holds a substantial Bitcoin treasury of $192.1 million as of March 2026, leaving the company exposed to Bitcoin price volatility and broader crypto market sentiment. Risk 6. Capital-intensive further build-out required. Scaling Ward County toward its full potential of up to approximately 700 megawatts and pursuing the N-scale expansion option requires tens of millions of dollars of additional capital expenditure that management intends to fund partly through Bitcoin treasury sales, introducing execution and market timing risk to the funding plan itself. Risk 7. Intense competition among miner to AI pivots. TeraWulf, IOND, Cypher Mining, and Hut 8 are all pursuing broadly similar AI and HPC infrastructure pivots. Several with larger scale, more diversified tenant relationships, or bigger headline hyperscaler contracts, competing directly with Ionic for future tenant relationships and investor capital. Risk 8. No underwritten price discovery. Because this is a direct listing rather than a traditional IPO, there was no roadshow-driven institutional book-building process to establish demand-based pricing. The $53 private placement price is the most recent reference point, but it may not reflect actual public market trading levels once shares begin changing hands freely. Section 14. Valuation. Most recent private round price, $53 per share. Series A Preferred, June 26, 2026. Implied pre-listing valuation, approximately $2.0 billion. 6-month post-listing sale floor for private placement investors, $70 per share, informal and contractual, subject to limited exceptions. Contracted 10-year N-scale lease revenue, approximately $1.95 billion, up to approximately $2.6 billion with expansion. Trailing 12-month revenue ended March 31, 2026, $152 million. At its approximately $2.0 billion private placement valuation, Ionic trades at roughly 13 times trailing 12-month revenue, a rich multiple by traditional data center standards, but one that reflects the market pricing in the long-dated NVIDIA-backstopped N-scale lease revenue, rather than current trailing financials alone. Because this is a direct listing without traditional book building, actual post-listing trading levels could diverge meaningfully from the $53 private placement reference price in either direction once existing shareholders begin freely trading. Section 15. Upcoming catalysts. Nasdaq direct listing trading debut, expected July 28, 2026. First real-time public market price discovery for the stock, with no underwriter price support. First post-listing quarterly earnings report will show whether the Q1 2026 leasing revenue ramp and narrower net loss trend continued. N-scale 89 megawatt expansion option exercise, ongoing subject to regulatory and power approvals, would lift contracted lease revenue from approximately $1.95 billion to approximately $2.6 billion. Additional tenant announcements, for example the Microsoft option, ongoing, would diversify Ionic's revenue away from single-tenant concentration risk. Ward County capacity build-out progress toward approximately 700 megawatts, a multi-year catalyst, central to the long-term growth thesis, beyond the current N-scale committed capacity. Bitcoin treasury deployment decisions, ongoing, will signal how management balances funding growth against preserving balance sheet flexibility. Section 16. Long-term outlook. Ionic's long-term outlook depends on whether it can successfully replicate the N-scale lease structure, contracted, creditworthy, long-duration tenant revenue across a larger share of its Ward County campus and potentially additional sites, while continuing to wind down its exposure to volatile Bitcoin mining economics. If the company executes the disclosed CapEx plan, secures the N-scale expansion option, and lands additional tenants such as Microsoft, Ionic could evolve from a single lease story into a genuinely diversified AI infrastructure landlord, with a scale advantage rooted in its low-cost, bankruptcy-acquired asset base. If execution stalls, or if Bitcoin-linked segments of the business continue to represent a meaningful and volatile share of results, the company risks being caught between two identities, neither a pure-play AI infrastructure business nor a focused Bitcoin miner, a positioning that public markets have sometimes struggled to value cleanly. Over a 5-year horizon, the AI data center power constraint dynamic provides a supportive industry backdrop, largely independent of company-specific execution. But Ionic's own success will hinge on tenant diversification, continued access to capital for build-out, and disciplined management of its residual Bitcoin exposure. Section 17. Bull Case. The N-scale lease performs exactly as contracted, with NVIDIA's rent guarantee providing genuine downside protection through at least the first 5 years. Ionic successfully exercises the 89-megawatt expansion option, lifting contracted revenue toward $2.6 billion. Microsoft or another hyperscaler signs on for additional Ward County capacity, diversifying the tenant base beyond N-scale alone. Management successfully funds the disclosed CapEx plan through a mix of cash on hand and opportunistic Bitcoin treasury sales without diluting shareholders. And the direct listing, despite lacking traditional price support, settles into a stable trading range that reflects the underlying contracted cash flow value of the business. In this scenario, Ionic re-rates from a recently pivoted single-tenant story into a recognized diversified AI infrastructure operator, supporting a valuation well above its $2.0 billion private placement reference level. Section 18. Bear Case. Heavy, immediate selling from former Celsius creditors and other existing shareholders on listing day, unrestrained by traditional lockup agreements, drives the stock sharply below its $53 private placement reference price in the absence of underwriter price support. The N-scale expansion option and any Microsoft tenant discussions stall amid power and regulatory approval delays. Residual Bitcoin mining and treasury exposure continue to introduce volatility unrelated to the core AI infrastructure thesis. Further CapEx requirements outpace available cash and Bitcoin sale proceeds, forcing a dilutive capital raise. And Ionic's small scale and single campus concentration leave it at a competitive disadvantage against larger, more diversified miner-to-AI peers like TeraWulf and IOND in the race for additional tenant relationships. In this scenario, IOND could trade as a volatile, thinly understood, pivot story stock well below the value implied by its contracted N-scale lease revenue. Section 19. Final Investment Conclusion. Ionic Digital tells a genuinely compelling, if unusual, transformation story. Assets that emerged from one of the crypto industry's most notorious bankruptcies have been repurposed into a data center campus, now anchored by a nearly $2 billion NVIDIA-backstopped lease with a global AI hyperscaler. The company's Q1 2026 results already show this transformation flowing through the financials. Leasing revenue now dwarfs Bitcoin mining revenue, and the net loss has narrowed considerably. That is a real, demonstrated pivot, not just a forward-looking promise. At the same time, the mechanics of how Ionic is coming to market deserve just as much attention as the underlying business. A direct listing means no underwriter-supported opening trade, no traditional lockup schedule, and immediate potential selling pressure from a shareholder base that includes former bankruptcy creditors who may simply want liquidity rather than a long-term equity position. Combined with the company's single-tenant, single-campus concentration and its still meaningful residual Bitcoin exposure, this is a stock likely to see significant price discovery volatility in its early days of trading, regardless of the underlying business quality. Bottom line, Ionic Digital offers investors a genuinely differentiated, contracted way to gate exposure to the AI data center power constraint theme. backed by an unusually strong tenant credit guarantee. But the direct listing structure, single asset concentration, and recency of the company's strategic pivot all argue for caution, particularly around the initial days of trading. This report does not constitute a recommendation to buy, sell, or hold IOND shares. Readers should review the complete Form S-1 on SEC EDGAR and consult a qualified financial advisor before making any investment decision.